Welcome to the Meb Faber Show, where the focus is on helping you grow and preserve your wealth. Join us as we discuss the craft of investing and uncover new and profitable ideas, all to help you grow wealthier and wiser. Better investing starts here.
Meb Faber is the co-founder and chief investment officer at Cambria Investment Management. Due to industry regulations, he will not discuss any of Cambria's funds on this podcast. All opinions expressed by podcast participants are solely their own opinions and do not reflect the opinion of Cambria Investment Management or its affiliates. For more information, visit CambriaInvestments.com.
This episode is sponsored by our friends at White Charts, the all-in-one platform for investment research, client communication, and proposal generation, built specifically for today's advisors. Podcasts are flooded with sponsors these days, but this is one I've used myself for over a decade. When I was updating my shareholder yield book last year, where did I go to find shareholder yield data? White Charts. What platform did I pull charts from to include in the book? Also White Charts, and you know I love CAPE ratio. If you've ever seen me present on a webinar, you've probably seen those long-term CAPE ratios I built with White Charts too. The best part's White Charts doesn't help you just research data, it helps you communicate it. You can easily build charts and proposals to share with clients so they can see exactly what's going on in the markets and what you're doing about it. If you haven't signed up to test out the platform yet, I don't know why. You get a free trial to play around and see if it's for you. And if you feel like it and decide to stick around, White Charts gives my listeners a special 20% off your initial White Charts professional subscription. So go to go.whitecharts.com/meb-faber or check out the link in the show notes to start your free trial today and save 20% on your initial subscription. Once again, that's go.whitecharts.com/meb-faber or check out the link in the show notes. Welcome back, everybody. It's full-on summertime. We got an awesome show today. We're joined by Sara Naison-Tarajano, which is the global head of private wealth capital markets at Goldman Sachs Apex Family Office Coverage, where she works with over 600 families around the globe. She spent her entire career at Goldman, lifer, as one of the most keyed-in people in what family offices around the world are thinking today. Sara, welcome to the show.
Thanks for having me. Very happy to be here.
You know, you don't find too many career lifers. You know, you just got to Goldman, said, this is where I'm meant to be. Is that what it was? It was a well thought out, deliberate path. What happened here?
Not so much a well thought out, deliberate path. It's actually a funny story. I thought I wanted to be a lawyer. I had a good friend who had studied finance. We were at Yale undergrad together. She wanted to live with me in an apartment. I thought I was going to live at home. She suggested I apply to a bunch of different finance jobs, which I did. Goldman was my first interview. 16 interviews later, I actually got the offer that night to start in investment banking. I found the process quite exhausting, accepted on the spot, and canceled all my other interviews with lots of other investment banks, consulting firms. She started at Goldman as well, actually, left after 8 months, which is a story we still laugh about. 26 years later, I'm still here. And what I think is interesting is because I didn't come in with an objective or a plan, I really let the business, the clients guide me. And I really followed my passions. I followed what I love. I went from investment banking to equity derivatives to cross-asset derivatives to wealth in 2010. And so, you know, my entire career has been about finding what I'm passionate about, working with clients really across global markets. And it's been a great ride. 26 years later, I'm still here and very motivated by what I do.
That's great. You had a couple, like you mentioned, a couple different roles over the years. And about 5-6 years ago, you took a look around, and you can correct me, and said, hey, look, you know, we're not doing enough in the family office space. We're not doing anything in the family office space. Maybe give us an overview of kind of starting out Apex. What was the inspiration and what made you want to build that out?
Sure. This really started in 2018. And, you know, I had been in wealth since 2010, and we certainly did some business with family offices, but we didn't really have a distinct effort focused exclusively on family offices. And I was doing, along with my colleagues, a lot of trading with family offices. And what we started to observe when we were working with these family offices is that they really looked a little bit different than your classic private wealth client. Many of them had real institutional infrastructure around them. They had chief investment officers to manage the portfolios. They often had people looking after the private side of the book, the public side of the book, and they ended up looking and feeling a lot like mini institutions versus private clients. But at the end of the day, they're managing money for, you know, individuals, people with two legs who have the same things they need to think about, from a trusted and estate perspective, from, a next generation perspective. And so we really sought to build this model that brought together within wealth what we thought was really important for these family offices from a wealth perspective, but really brought all the institutional capabilities of Goldman Sachs to these clients as well. So we built a business plan starting in 2018, and the business has just, continued to grow and expand. We're now fully global. We have people in New York, on the West Coast, in London, in Paris, in Switzerland, in Hong Kong, in Singapore. And it's just been an incredible thing to be able to build a business within the confines of an institution with as much history and as great a firm as Goldman Sachs.
So give us a little overview, because when someone says family office, it can mean a lot of different things, a lot of different people, and it changes over time, as markets go up. And, when you think family office, what does that kind of mean to y'all?
Yeah. So when I think about family office, the way that I really think about it is that someone has put infrastructure around the wealth of their family. So rather than just being an individual who's managing a portfolio and thinking about asset allocation in that regard, this is really about families thinking about how they want to manage their wealth from a governance perspective, from a mission statement perspective, beyond themselves, really with the idea of this wealth living for generations. And I think what the findings have been in the community, which are correct, is that if you don't have that governance, that infrastructure around a family's wealth, it's very difficult for that wealth to last for multiple generations, right? And thinking about things like, how much are you paying out to the next generation? What do the dividends that you're paying out to the family for living expenses look like? And so it's really just putting that professionalization around the wealth of a family.
We just did a podcast with Victor Haghani, who has a book called The Missing Billionaires. And I can't remember if it was Vanderbilt's. It must have been the Vanderbilts. But he talked about in the beginning of the book, one of the richest people in the world, old Cornelius. And then the family did a reunion a few generations later, and they're like, no one had any wealth left, right? It was either spent or mismanaged or whatever it was. And, that's like the old concept of, a few generations pass. A lot of people just love to do their best to get rid of it. So there's very clearly a need for thinking about money. Is there an asset size that typically trips for you guys? Like, because it's interesting that you mentioned you led with structure first, but is there like hey, you got to have 10 million, you got to have 100 million, or maybe that's less important than kind of how you're getting set up?
Yeah, so I think when we think about setting up a family office, you really want to make sure that the cost of setting up that family office doesn't really dig in too much to your principal. And what that means is, a family office, in my mind, doesn't really make sense at 10, 20, or even $50 million. We typically see family offices being set up in the hundreds of millions of dollars and the billions of dollars, because you want to be disciplined that whoever you're hiring, if it involves office space, if it involves hiring investment professionals, that ultimately the yield on the portfolio has to cover that. And so, at smaller levels than that, we would advise clients to really use firms, hopefully like Goldman Sachs or other firms, to really be their family office. You have to have significant capital to really fund the cost of developing your own family office.
Yeah. So, all right. So let's say we got a listener who's got 100 million. They said, they call you up. They say, Meb, I love your guest, Sara, really bright, smart, Yale Bulldog, so tennis player. We like her. We're going to reach out to her. What do you tell them? Like, usually it's a matriarch or patriarch. I feel like almost always it's like the one person leading. They built the wealth, and they're like,
Sure.
oh, shit. Now I got to deal with this. I got these idiot nieces and nephews. Like, at least one of my kids, my 5 is going to be a mess, like on and on. But they're like, all right, we're going to reach out to you guys. What's kind of the initial conversation? Is it usually for them they're coming with like portfolio, like they're like, oh, you got to get my life in order here? Or is it more of a logistical situation where it's almost like all the things in wealth management, like, oh man, I don't have any trust, I don't have a will, like my get structure with taxes in Spain. or is it just totally bespoke? Is there any generalities?
It's a great question. So I'd say, first of all, my team's expertise is 100% on the investing side of the equation. So we really dig in on asset allocation and investing. Having said that, to do that properly, when you have a team of people, which I have a super talented, very technical team that does nothing but work with family offices, they develop deep expertise in the other parts too. And what they'll do is sort of bring in the trust people, bring in the estate people. But I think the most important part of that first meeting, which you can imagine, I do so many of these first meetings. It's one of my favorite parts of the job is, meeting with someone. You can imagine, because of Goldman Sachs's M&A franchise, because of our equity franchise, we see a lot of change of circumstances. Someone who's sold a company, someone whose company is going public. And often they've spent almost no time thinking about, their own financial well-being, because all their energy has been focused on building, this incredible asset. And so what I really come in and do, and other members of my team, is really start the conversation about, what's important to them, right? And those questions are things like, how do you see your money over generations? Are you leaving this to your next generation? What are your charitable aspirations? What does it cost you to live today? And what do you think it might cost you to live in a year and 5 years? Because you can imagine when someone has a company that goes public, maybe their cost of living is going to increase as their wealth level increases significantly. What is their risk tolerance? We have an incredible group at Goldman Sachs called our Investment Strategy Group. One of the things we do for every client we meet with is actually put their portfolio, whether it's an existing portfolio or a portfolio that we're designing and testing, through a stress test to say, this is the type of drawdown your portfolio would have over these market cycles over the last number of decades. Can you handle the level of drawdown associated with a more aggressively allocated portfolio or not, right? Because when I think about wealth preservation for clients, the most dangerous thing is permanent loss. Permanent loss is what everybody should be afraid of. And how do you create permanent loss? Well, paying taxes, but we can't help that. We all have to pay taxes, right? And the other way is to be a forced seller, whether that's you're a forced seller because you've put too much leverage on a portfolio and you have a margin call, or whether you're a forced seller because the equity market has gone down and you've panicked and sold. Those are the things that we really want to avoid. And so a lot of analysis on understanding the risk tolerance. And I can say that it's one of the accomplishments I'm most proud of this business is how clients have managed to really navigate. I mean, even this past April, right? More than a 20% drawdown, our family offices were buying, right? They were taking advantage of elevated vol levels. They were selling puts. They were buying stocks that they deemed too expensive a month before, and really sort of training clients to sort of understand how to operate through market cycles.
Yeah. I imagine, and I want to spend some more on the investment side in a minute, but I imagine most people that come to you, and you can correct me, come to you from a place of concentration. So they either, they got rich by building a business, by investing in one stock or a handful of stocks, or being an angel investor. But I imagine it's mostly some sort of business related. One, is that the case? And then two, is that like, how do you counsel these people? Because, the mindset, so many, not just investors, but entrepreneurs could be decades. For the younger folk, it may not be. Maybe they just had it all in some crazy crypto, but head down, focused on building wealth. And all of a sudden they wake up one day and they got 100 million. They're rich. And then kind of, as you talk about preserving, perhaps might be a slightly different mindset and skill set. Is it usually concentration that kind of comes to you, or maybe not so much?
Yeah. So when I meet the first generation of these wealth creators, which is a lot of what I do, candidly, it is often extremely concentrated in single public stocks or extremely concentrated in private companies. And it's a really delicate balance, because this is a person who has created extreme wealth through being incredibly successful. And there, are so many cases of this, we've all seen it, where concentration has built, enormous wealth. And so the way that we approach it really is to make sure that people understand all those questions I just went through. What are their living expenses? How are they thinking about diversification over time? But I'm not going to go in there and tell the CEO of a company that they shouldn't continue to be very concentrated in a stock where they're really continuing to drive that outcome. But what I might say to them, and we have an incredible single stock risk management team here at Goldman Sachs that one of my partners runs, and I actually grew up in that business in derivatives, is to say to them, you might want to take advantage, if your stock is continuing to perform really well, take a little bit of liquidity off the table, begin that diversification process, begin thinking about your next gen, all of these things, so that it doesn't have to be one or the other, but that you are over time building a diversified portfolio that isn't just about this one asset. But look, you just have to pull up the Forbes list of billionaires. A lot of billionaires have very concentrated wealth. And our job is to help them think about their wealth, outside of that concentrated risk.
Yeah, music to my ears. It's hard. So many people we talk to that have the concentrated, they say, look, this is how I made all my money. Who are you to tell me that I should be selling this? And the challenge, of course, is the hundreds, if not thousands of securities that, didn't do as well. And the challenge that we always talk to people is most want to think in binary terms. Should I sell this? Should I keep it? And it doesn't have to be that, right? It could be, you could sell a little bit.
It really doesn't. And we always have a little bit of approach, like think about this in quarters. Do you want to think about creating some liquidity on a quarter of this? And by the way, you can take that quarter and you can think about it over a year, right? Like you can sell it in pieces. You can think about other strategies. You can think about derivative strategies. You could think about collars, right? Buying a put, selling a call, protecting the downside, keeping some upside. You can, sell calls to create some yield. They're all different strategies. Ultimately, I think what the message needs to be, if something were to happen to this individual position that is beyond your control, maybe it's regulatory, maybe it has nothing to do with how you run this company, then you just want to make sure you have enough assets outside of this asset to take care of your family, to take care of yourself, and to have your legacy live on. And those are the questions that we're always discussing with clients.
As you mentioned, you have clients all around the world. And if you look at countries and you make a broad generalization, and this probably isn't at the family office level, but just at the broad country level, U.S. seemingly has a much greater culture of equity investment than, say, Europe or Japan or Asia or other places. But at the family office level, I imagine they're probably more similar. Are there any main differences when you're talking to clients? And I mean, obviously there's tax differences and regulatory, but
Sure.
as far as kind of, the family office style, any main differences that you see as you have these conversations?
Yeah, maybe I'll start with a little bit of some of the differences I see in the family office model versus your average wealthy person, and then some of the things I see in the US that might be slightly different than the rest of the world, if that works.
Sure.
So I'll start with kind of family office versus your average wealthy client. We typically see a higher allocation to alternatives. We see a model that looks a bit more like an endowment style model. We actually published a family office report in 2023. We're publishing another one in 2025, so look out for it. And I'm super excited to compare. Actually, I haven't seen the survey results yet, to see how asset allocation has changed, if at all. We actually find that many of our family offices stay really true to their asset allocation. Our 21 to 23 survey showed very little change. But in our 23 survey, there was a 44% allocation to alternatives, which for an average wealthy aggressive portfolio is more like 25%. And I think the reason you see that is that there is an illiquidity premium over time and has been for the last number of decades. And if you are at a certain level of wealth, you can stomach less liquidity because your smaller percentage of liquidity is still quite a high number, right? So we tend to see a bit more of a barbelled approach. We see more investing in equity, as you said, both public equity. We see a lot of allocation to alternatives. And then we typically see, in some ways, what's interesting is a higher cash balance from a percentage basis, because our family offices historically want to be kind of running into the market when others are running away. And they like this concept of dry powder to action in more volatile markets. And we've certainly seen that. And I think that's pretty true across the globe. I'd say one trend I see in the US that's a bit different, and I think it's the nature of the US market and the strength of the US equity market, is a bit more single stock trading from our US family offices versus, for example, our European family offices. It's just a bit in the DNA. We've talked about it. Also, a lot of our family offices, in the US are people that founded companies that are still public today. So I think that's an interesting trend to speak about. And then I would also say, the tax regimes just impact how people trade. And so, in the US, we see a lot of people buying stocks that they hold for the long term because it's just so expensive. I mean, if you think about, look at the Mag 7, you think about the gains that people have on those stocks. It's a pretty expensive value proposition to sell those in the US. You've got to think there's a lot of downside risk for those sales to make sense and take those tax hits, especially for people in New York or California. And so tax is a really important overlay. And we spend a lot of time with clients in the US in particular thinking about tax advantage investing. So that's certainly a theme. One thing we see most out of US family offices, but I think this is increasing everywhere, is a bit more direct investing in private markets. But we're seeing that trend certainly hit Europe and Asia. So family offices building sort of deep investing teams, many from the private equity world. We have such a large financial service industry here in the US. So the professionals that are available to US family offices to come in and do some of those deep dives on single asset private investing is probably a trend that we see in particular in the US. One trend that we see around the globe is direct real estate investing from families all over the world. I think there's something there for families, liking hard assets, liking assets that they can touch and feel, particularly in areas where they live, right? It's part of their community. So I think that's a big deal. And I'd say sports as well has been a theme for the same reason. But again, this idea that many families like investing in their communities. So we often see people asking for sports teams, whether it's, buying entire sports teams or pieces of sports teams related to where they live, and being able to create economic opportunity for others in those areas is often important to family offices as well.
Yeah. Certainly the equity-like orientation, and listeners, I'm grouping in not just stocks in this, but under the alts bucket, things like private equity, venture capital, and even real estate to an extent, if it's cash flowing, that's all equity-like orientation. And if you look at all the various surveys, so not just from Goldman, but any others that talk about, the levels of wealth from 100 grand, 1 million, 10 million, 100 million, you see this increasing portion that's either business or equity-like allocation, right? And so we often think and talk about a lot about even if you don't have a lot of money, having that equity orientation is super important over the long term, and things like inflation. We don't have much today, but can and have over time. So let's talk portfolios, your favorite, mine too, and how do you guys kind of think about, how do y'all say, all right, we're going to move you from X to Y. Here's the opportunity set of the world. I mean, since y'all started the Apex group, really take it back to the GFC, we've been in kind of one market environment where it's just SPY has been dominant over everything. And this year, getting a little jiggy, getting a little different, but maybe talk to us about how you guys think about portfolios.
Yeah, look, I think we still, and again, our investment strategy group is a big part of how we think about this. We still believe in the U.S. preeminence theme. Clearly, it's come under a little bit of pressure this year, and I don't think that means you can't do tactical things all around the globe, and we talk about that with clients. But if you really look at U.S. equities, you've got, an incredibly productive labor force, right, versus the rest of the world. You have earnings growth that just continues to outperform the rest of the world. You've got innovation. AI, just continues to be a theme that people are quite focused on. And you've got, a relatively productive regulatory environment as well. And so these are all reasons why we continue to favor the U.S. when we think about overall client portfolios. And at the end of the day, what drives equities for the long terms is earnings growth. And the earnings growth, has continued to be there for U.S. equities and continue to outperform the rest of the world in a pretty meaningful way. We certainly think tactically this year we've seen, given the fiscal package announced by Germany and the infrastructure package, I should say, more people focused on things like, financials, defense. But if you really look at what has grown earnings in equity markets, it's technology. And these foreign markets are much more industrial. They're a bit different there. So I would say U.S. equities preeminence continues to be a theme. Certainly, we've talked to our clients, and we always recommend, hedging at least 50% of their U.S. equity exposure back to the home currency or whatever currency they're measuring themselves against. So for our clients in Europe, that's often the euro. And those dialogues are ongoing because, certainly the U.S. dollar has come under pressure, and I think will continue to be under some pressure in the near term. I'd say, we think alternatives are a really important part of a portfolio as well. One thing that we think a lot about is how different the market looks than when I joined the firm in, for example, 1999, just in terms of the number of public companies that exist. It's like about half, not quite, but almost.
99, that was my favorite bubble. That was rocking and rolling. I loved it.
It was rocking and rolling.
I owned all the internet stocks. I would have been, it's funny because we talked to the younger generation today, and so I was a senior in college, and I think you're in about the same demo.
Yeah, I graduated in 99, so maybe I'm
good times. My professors are trading stocks, so I try not to look with too much judgment at the young Robinhood crowd trading zero-day options and meme coins and everything else, because that was certainly me in a different name, probably as a student in the 90s. But okay, so what's changed? I interrupted. Sorry.
No, so what's changed is just there is an incredible amount of money to be made in the private markets. If you think about what type of market cap, like the Googles of the world went public and the Microsofts of the world went public, it just looks totally different today. Companies are going public at multiple billion-dollar valuations, which means along the way, there's money to be made, right, in private markets. And so we think it's really important for our clients to have exposure to that. We think it's one of the most unique things about the Goldman Sachs model, right? We have a asset management firm built into our global business, right? And so for us, really helping clients think about how much they're comfortable having in alternatives. And for an average non-family office client who's more aggressive, who's younger, who has time, right? We wouldn't recommend this for somebody, in their 80s or 90s. We think that number is 25%. And so we really spend a lot of time, as I said, sort of going through this analysis, sort of explaining the volatility of a portfolio, making sure people really understand the yield on a portfolio, and also what are the goals. And you sort of alluded to this earlier, but the goals of a private client portfolio is to beat inflation post living expenses. That's how you grow your wealth over time. If you can beat inflation post your living expenses, you will continue to grow your capital over time. If you can't, you will not. And it's really, the equation is that simple. So it's putting all of the metrics together to sort of understand how much do you need to live. And by the way, we're talking about that changes, right? You may spend a different amount in your 40s and 50s when you're putting children through college than you do in your 70s. So this is an ongoing conversation that people need to be having with their wealth advisors. How much do you need to live every year? Is your portfolio set up to deliver that? And is it set up to beat inflation?
You've had these conversations a lot. And so as you've sat down with these families over the years, when it comes to the portfolio part, are there any big pushbacks? Are there any, conversations that you kind of consistently have to have with people? And we can get to the behavioral and the spending stuff in a minute. But as far as the portfolios, and I'm thinking in my head, coming into this year, we talked to a lot of financial advisors over the last few years. And if you mentioned foreign stocks or emerging market, they're just like, oh, guy, like every client meeting for the last 5 years, they ask me, why do we still own emerging market stocks or whatever it may be? They changed in time. But are there any, commonalities from the conversations over the past few years?
Sure. I'm going to say a slightly different one, which I think is one of the ones that's been the toughest, honestly, is that, you have someone who comes into a big pool of capital. That's often when I'm coming in. And they want to they're anxious and they want to sit in really safe assets. And they're anxious to invest in equity markets, or they're anxious to invest in alternatives because they feel like valuations are too high. But the fact is, over time, and you could look at cycles, these markets keep going up. And so you can wait and you can wait and you can wait, and you may not get your shot. And so I think that's actually the thing that I find the most dangerous is clients who just sit in cash or sit in fixed, short duration fixed income, afraid to invest. And, by the time they're ready, and maybe they're waiting for a correction, but before the correction happened, the market already went up 30%, and then there was a 10% correction, and they're still 20% above where they would have been. And so what we try to do is say to clients, look, if you're investing for, cycles and years, which most private clients are, you've got to start. You've got to just invest 25% now. And it may not be the perfect timing, but 5 years from now, it won't matter, right? And so you can have a disciplined approach and you can divide it over 12 months or even 18 or even 24, but you can't beat inflation and you can't generate enough yield to cover your cost of living if you're sitting in cash. So that to me is the most dangerous thing that I encounter.
I imagine y'all's investors, are a little more global. So the conversation about having ex-US assets for Americans, most ex-US investors are already much more global. And so it's an easier conversation, I feel like. Has that been an easy conversation, a struggle, or most people want to be, all in on US at this point, or is that changing?
I think a lot of our portfolios definitely have a U.S. predominance tilt, but they still have exposure to foreign markets, emerging markets, developed markets. And increasingly, we've been talking about, if you're going to invest in Europe, we always historically had done that on a hedged basis, right? Back to dollar. And, are there parts of the portfolio where you want to keep your Europe equity exposure in euros, for example? And so those conversations are shifting. I'd say the other theme, and while it's not in our asset allocation that people can't talk enough about right now, is gold. I'm sure you're hearing the same. And I think, that's to be expected given some level of, geopolitical, macro uncertainty, pressure on the US dollar, bit of a safe haven. And we see, double-digit 12-month upside in gold. And so I would say clients all over the world are talking about, best way to get that kind of exposure. And most are honestly just doing it through the ETF because the storage is really expensive. But we see that more tactically, not part of our asset allocation, just to be clear.
One of the things that kind of drew me to you and what y'all are up to is I feel like, particularly with family offices, just wealthy people in general, and this applies to everyone, but with family offices, all of a sudden you have multiple people and multiple generations becoming involved. Like that's kind of the whole point is you had someone who made money or a couple or a family that made money. And then all of a sudden they're like, all right, well, what are we going to do with this? And then all of a sudden, instead of one person, you got 3, 5, 10, 20. And that creates a whole different dynamic when it comes to money.
Sure does.
So talk to us a little bit about the education component. So
Sure.
not, you got the main matriarch, patriarch, that's one lift. And then it's like, all right, how do you guys deal with everyone else? What's the process of expanding your universe to all these other folk?
Sure. And it's, getting involved with the next gen has also been one of the most fun parts of the business for me. My oldest is 21. And so some are that age range. And I find it really interesting. I'd say, first of all, it has to be family led, right? So people have different perspectives on how much they want to involve their next gen in the business, in the wealth, in the family office. My observation, my humble observation is that I find more transparency tends to be better. You got to figure out the age that makes sense. And there are lots of people who work on this with families. But I think when there isn't transparency, it can lead to sort of bad behavior, people being paranoid, less of the sort of siblings getting along, more competition. If people just sort of understand what's in front of them, how it's going to work, what the setup is. That's why the governance aspect of family office is so important. And the best CIOs of family offices, they get this right. They figure out with the family, they do family meetings. Sometimes these family meetings are entire weekend offsites where, the portfolio is presented, the plans are presented, people feel a part of it, people feel included. And so most of our family offices really do involve their next gen. And we have education programs that start as young as high school, right? I would say children of very wealthy individuals are not very different than any children, which is sometimes this stuff is better taught by somebody else than yourself. So maybe send them, to Goldman Sachs to learn how to analyze a balance sheet than trying to do it yourself, even if you're one of the most brilliant minds in the world of finance, right? And so we have a whole next gen initiative and we run all sorts of different programming. We run programming for, I said that high school age group, the college age group, the post-college age group, and then we do some really fantastic conferences with Next Gen. And we find, in some ways they have similar objectives. They want to preserve the family's wealth. They want to think about the mission of the family, the legacy. They're often much more sophisticated on things like technology and AI. They're often more focused on certain issues like climate change than the generation before, which I think you'd find across the board on the next generation. And so it's really sort of making sure that we're delivering to them what they're interested in and showing them opportunities. And some of it is just education on what we talked about, portfolio construction, so that they're empowered as they get older to make the right decisions, to think about their spending, to think about their objectives. It's a lot of fun.
Do you just hand them like the Goldman family office manual? Is there like webinars? You said you do in person. Like, is it just like a whole multi-education process for the whole crew? How's it work?
We don't typically just hand them a book. We do a lot of hand-to-hand combat, one-on-one meetings. We develop these relationships. We get close with these family members. That's certainly a big part of it. The education is both in person and on Zoom. So we do some sort of deep finance education on Zoom that I think people really appreciate and find useful. At the end of the day, you've got to keep people interested, right? I mean, reading a deck on family office, even though I like our decks, it's just not that exciting. So we try to make it sort of delivered in person, whether that's a person over Zoom or a person, literally in an office with somebody. But I think it sort of needs to be done that way. It's a hard thing to just sort of go in and do a module, for example.
Yeah. We talk a lot about the education component, and one of the downsides of not teaching money or investing in school is that it's an opportunity for folks like yourself and myself and others, to kind of bridge that gap, and it is I feel like it's changed over the generations. Our parents' generation perhaps a little more reluctant to talk about money than maybe the current and younger generations. It may be just the internet and transparency. It's just out there a little more.
It's so important. Like with my own 3 daughters, I want them to understand, like, what is interest? What does it mean to save? What does it mean to invest? How do you evaluate a company? I think that's something that the entire country doesn't have. And so I'm a real fan of increasing the financial literacy of our population. I know your podcast is focused on that, and I think it's great.
Talk to us about the conference. So you guys just wrapped a conference. What's the main focus? What's the main topics that everyone was interested in? And what was the format?
Yeah, so we do a big global conference. We had 200 really significant family offices from around the world, 17 different countries, believe it or not, here in New York. I kicked us off with our CEO, David Solomon. John Waldron was there as well. Really a very high level of firm commitment to this client base. So we had, believe it or not, 49 different senior leaders at Goldman Sachs delivering content, and then a number of different external speakers too, including Stevie Cohn, Josh Wolf from Lux Capital, Jens Greed, founder of Skims. I could go on and on. But really the idea is to convene family offices to get to know each other so that they can network and really convene around topics that are relevant to them. So everything from investing in technology to geopolitical. We had Jared Cohn give a really incredible, he's on our management committee overview, and he's spent a lot of time in government, traveling all over the world. So really giving an interesting look into the geopolitics of the world. And so what I would call our conference is super content heavy. Right. So really just unveiling for these clients who are at the forefront of investing, of innovation, and also giving them some time to sort of gather, get to know each other, and create networks, which we know is really important for this client base. They do a lot of investing together. They do a lot of brainstorming together. It was a fantastic day. It's one of my favorite. And, we worked for a year putting this together. The team worked so hard. And it was really fantastic. We ended at Zzz's with a really fun dinner for those who know that club in New York. The food is tremendous. So it was just a great day.
It's fun to do those type of social events in the real world again, because you do have the interaction and you hit on it. Where it's not just the actual conference and the topics, which is great, but the fact that people can mingle and amongst their peers. Were there any topics that stood out as being particularly noteworthy of just like the current environment? Whether it's, hey, maybe the IPO window is opening, or hey, obviously geopolitics. Everyone's always obsessed with geopolitics. Tariffs seem to be fading a little into the background. I don't know. Jerome Powell, what's he going to do? Anything come to mind?
Yeah, I mean, so many different things came to mind. Definitely more optimism around the capital markets, by the way, which also informed some of our U.S. preeminence theme. And so that really was a topic to note. We've seen, I think, 12 IPOs in the last month, right, after being a little bit closed after the tariff announcements in April. And so the capital markets feel like they're back, and, IPOs have been trading incredibly well. And so a lot of focus on, what is our M&A forward pipeline going to look like? What does the IPO calendar look like? That was certainly a theme. I would say a lot on the future of AI, right? This is just, a theme really every time I talk to clients. And, this concept that we're really at the tip of the iceberg. I think Jan Hase has put out a piece where it's like the last quarter, only 9.2% of companies are using, AI to produce goods and services. You just got to imagine we're just at the very start here, right? So clients really digging in and trying to understand that, I thought was interesting. I thought there was a really interesting talk by Josh Wolf on technology. And also he had this great presentation to show that so much innovation that we've seen in technology actually first appeared in science fiction. And so like the first tablet, 15 years before it actually came to being. And so now I'm going to start watching a lot more sci-fi, because maybe that's where we're going to see all the innovation come from. But yeah, it was just a great day.
When things go wrong, so let's say you got a family, they come in, you onboard them, everything's going great. And all of a sudden a year later, it's like what is a traditional headaches that you guys have to deal with? Is it intra-family kind of squabbles about purpose, about direction? Is it they're just spending too much damn money? What are the usual culprits?
Sure. I mean, look, I'd like to think, and we have a great team, that we try to avoid a lot of that by having very regular dialogue with our clients. There really shouldn't be.
Family.
It's still family. And I would say that most of the issues that take place around families are what you said. They're family-related issues. There's a death, there's a divorce, there's some sort of family dynamic that is, challenging to navigate. And you just have to hope that you've built relationships with enough people in the family to be able to navigate that, right? We have situations where clients have gotten divorced and we've been able to continue to cover both sides of the family. Families are complicated, right? There could be a falling out with an adult child. This is where, goes a little beyond our area of expertise on the investing side, and where, people, sort of need to bring in other resources, whether it's therapists who specialize in this. There's all different resources of specialty for families along these lines: governance specialty, therapy specialty, et cetera. Those are where we see things that don't work as well. But hopefully we've tried to get in front of some of these things when we spend a lot of time really understanding families at the front end.
So as we look out to the rest of 25, on to 26, what's on Sara's mind besides tennis, besides traveling? What do you think about? Anything in particular that you're excited or worried about or thinking about?
Yeah, look, I think it's natural. I mean, the market has shown incredible resilience in recent days and weeks. And, I think the second half of the year, we've got to see how, when tariffs actually come into play and what that looks like. I'm going to be paying attention to all of that and sort of understand. So I'm a little cautious going into the second half of the year to see the impact of tariffs, to see what happens geopolitically. I think all I still am constructive. I'm still, staying long markets for all the reasons we've talked about during this show. But, for clients who are more anxious, we've been, exploring hedging strategies. We've been talking about that, certainly on my mind. As we think through that, we'll have to see whether we get some, regulatory changes that put some positive pressure on the market, right? So there's, there are positive tailwinds too. We just try to stay pretty flexible. I think we're going to see a pretty busy summer on capital markets. I think I'm constructive this summer, but, I grew up in a derivatives business. I always think about managing risk and how to navigate that. And I'm somebody who tends to think that, when vol is low, you think about hedging. That tends to be my approach versus selling for all the tax reasons that we spoke about. And just making sure that your portfolio has a yield that you don't have to dig into principal to fund your lifestyle. That's a really key theme for me personally and our clients as well.
I'm ready for a quiet summer. I'm ready for like a sabbatical summer.
I don't think we're going to get it.
I don't need any more excitement.
We're going to get it.
I've been waiting for one of these, trying to do a little writing. Sara, this has been super fun. Definitely want to have you back. We can get deeper into some of these topics on specifics on portfolios and kind of y'all's solutions. If people want to, can they follow what you guys are doing? Or if they, said, hey, I love your message, want to become a client, like how do they reach out? Where do they find y'all?
Yeah, so if you go online to goldmansachs.com, I think I'm saying the right website. There are lots of places that you can interact and get connected. And so we would love to be helpful.
Sara, it's been a blast. Thanks so much for joining us today.
I really enjoyed getting to know you. Thanks so much.
Podcast listeners will post show notes to today's conversation at mebfaber.com/podcast. If you love the show, if you hate it, shoot us feedback at themebfabershow.com. We love to read the reviews. Please review us on iTunes and subscribe to the show anywhere good podcasts are found. Thanks for listening, friends, and good investing.